Hi, I'm John Stewart, Chief Investment Officer of Farmers Trust Company. This is the Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.
Hi, I'm John Stewart. Welcome to the Investor's Edge. First up, the week in review. Tech bomb. A metaphorical bomb was dropped last weekend in the technology world that called into question many of the market's previous assumptions about AI and how it works. A Chinese startup company called DeepSeek seems to have built a generative AI model that runs nearly 100 times more efficiently than existing models. Now, if the news is in fact legitimate, it may mean the need for far less chips, less expensive chips, and far less energy than previously thought. The current king of AI processing chips, NVIDIA, fell nearly 20% in value this past Monday before bouncing back modestly throughout the week. Also, some of the high-flying power generation companies that had been soaring in anticipation of massive power demand growth were hit even harder on the news. Nevertheless, the news wasn't all bad, even for the tech sector. Users of AI, like Meta platforms, that's what Facebook now calls itself, were actually higher on the news. And most other non-tech companies rallied as well. Why is this? Well, if AI becomes cheaper for everyone, that's higher productivity at lower cost. In other words, far higher profits for the rest of the economy. For this week's featured insight, volatility is opportunity. Many investors get nervous when markets become more volatile, as they seem to be doing here in the first few weeks of the new year. There are opportunities, though, to use volatility to your advantage through the options market. For example, you can sell an option that obligates you to buy a stock or market index, like the S&P 500, if it falls to a certain price level. In essence, you get paid to wait to buy something when it's on sale. And the more volatile the market is, the more you get paid. On the flip side, you can sell an option that would obligate you to sell a stock you already own if it rises to a higher price. Again, getting paid to wait, but this time to sell something you own at an even higher price. Bottom line, you're putting in place a mechanism to buy low and sell high while getting paid on both sides of the transaction, while you let the market volatility work for you. Looking ahead, government policy rubber meets the road. Well, investors have now spent the past few months trying to handicap what the new Trump administration is going to mean for government policy in the markets. There's certainly an underlying optimism that the administration will be pro-growth and pro-business, but there's also a lot of uncertainty surrounding the details of exactly what policies will be enacted. Now, as we move past the initial stages of cabinet confirmations and executive orders, Congress will begin to take center stage in the coming weeks to debate the particulars of the Trump agenda. The most important part of that debate will likely be around tax policy and the extension of the 2017 Tax Cuts and Jobs Act from Trump's first term. Now, the sausage making may get a bit ugly given the razor-thin margin Republicans have in the House, and that could cause more volatility as we move throughout the year. But as you now know, volatility is opportunity. Once again, I'm John Stewart. Thank you for watching The Investor's Edge.
The Investor's Edge, Market Insights with John Stewart, is brought to you by Farmers Trust Company.